What's up, everybody? So I refined my spreadsheet to make it a little more user friendly, and I'm happy to share the this dividend model. Just email me. I'll put my email in the chat, and I could send you the model. All these other websites, like these people will charge you like $20 a month to use their service. Let me just do this. If this was Google Sheets, I can set it up where it pulls in the data. So like I'm going to show you how the spreadsheet works. So ticker T, AT&T. So you have to enter everything in yellow, and the things not in yellow are calculated. And I'll show you how it works. But if this was automated, I could automate it, but I have to do it in Google Sheets. Not everybody has Google Sheets. If somebody wants to help me build a website, the thing is with these types of things, it just changes so much. I'll show, like, as I'm going through it, I'm going to show you how the spreadsheet works. I bet you I'll change the model. So if you want just like a fixed, like go to a website and you type in a ticker and it says buy or sell, you're never going to make money that way. You have to do a little thinking. So I'll just show you how this works, and you have to tinker with the data. I'm trying to make it as user-friendly as possible. So if you can just enter the data in yellow. So I'll just go through with you. But if somebody could throw out a ticker, that would actually be good, because a ticker that I could run this little spreadsheet with, and then it spits out the result, whether it's a buy, sell, whatever. So anybody have a ticker? I mean, obviously, it's kind of like when I ran my DCF models. Sometimes I don't get a good value, so it's never going to work perfectly. Anybody out there, you want to throw a ticker out, and I could do my DCF Excel file. I try to do with Zim initially, but it's so lumpy, Zim. If you know, I guess I'll just talk about it until someone throws out a ticker. So you input everything in yellow. This is just off the top of my head, so we may change it during this meeting. I gotta get new glasses. It's LRCX. So I'll show you how to do it, and you could do everything using free information out there. You don't have to pay for anything. But the stuff you pay for makes it a little more easier to look at. Not that I would ever pay for it, but I get the appeal of. So LRCX, Lamb Research, you want to make sure it pays a dividend. If it doesn't pay a dividend, it doesn't really make sense. Pfizer, we'll do that one next. But this should help you in your due diligence process. What was the stock price on this date? So it's just, this is a formula, and it just brings it back a year. So on 4/28/2024. So in Yahoo Finance, you go to historical data, and then the very bottom is last year. Well, that's 4/29. That's the open. So 92.15. And then market cap. Because I know some people are going to be like, I just want to press a button and have it do everything for me. But if you can't do any due diligence at all, you're never going to make any money. You have to do something. But I'm okay. So 91.8 billion. 91.8. 1, 2, 3, 1, 2, 3. So you enter the whole number. It formats it to billions. Then you get the free cash flow. And the good thing about typing things in, like we're going to enter the free cash flow. And this is probably the most important metric when looking at a dividend stock, the free cash flow. But if it's a weird year, like for instance, they invested a lot into CapEx because there's this big project going on. But in future years, it's not likely they're going to invest as much. Like you can look at the free cash flow in the prior 5 years. And if this year was like negative, for instance, and the prior years were positive, maybe you put positive into the model. But I'll just enter as I see it, 3.8 billion, and then net income. So most like the coverage ratios are using net income. I like free cash flow, but so this buyback yield, this I got from Simply Wall Street. I'm not suggesting you pay for Simply Wall Street, but I'm sure it's free somewhere. So I just thought it was a cool little thing, and maybe we would talk about it more. I don't even see it in here. Oh, right here. How come it didn't come up? So 2.6%. So that's a big deal when a company buys back stock, because that's how you get a return. Either the company pays dividend or they buy back stock. When they buy back stock, they're indirectly giving you money. Like for instance, if it was you and your 4 partners, and you all own 20% of the company, right? You each had a 20% stake in the company. And let's just say it was your company, or you started the you're the one who like makes everything and sells everything. They're just investors. And if say one of the people is your wife, but you bought back her shares, so you took hers out, now everybody moves up a notch. They go from 20% to 25%. So that is a way for somebody to give back. So it's either dividends or buybacks. But I didn't put this into the formula. I may do that. I just put this here, something to help me think about it. Consecutive years. You can go to Yahoo Finance for this. Go to historical data. And make sure you email me. I'm happy to share any of the stuff. So you can just go back to like the year 2000. On this website, Simply Wall Street, it goes back 10 years, which I think is appropriate for what we're doing. If somebody pays 10 consecutive years of dividends, that's just as good as 100 consecutive years. I don't really care. So I just need just the last 10 years. Maybe I should note that. 10 max. So just look at the last 10 years. How many years? This is consecutive. So it's obviously quarterly. You may have to eyeball it, but they haven't missed a dividend payment. And then how many dividend cuts? Once again, you kind of have to eyeball it, but it doesn't look like they cut their dividend. Although it's actually probably maybe easier to look at on Yahoo Finance. So in Yahoo Finance, go to historical data, look at the ticker, go to historical data, then go to dividends, and then, go back to like 2016, look at 10 years. And you could like kind of eyeball it. You see the most recent dividend was 23 cents, 2017. So it doesn't look like they cut their dividend. Number of cuts. So 0. This is just good kind of qualitative information to know, just to know. It gives you information, but I may build this into the, this is your result. Like it's going to say either strong buy either way, or sell. So maybe I'll add this information in there. It's not in there, but I'll show you how ranking works. And then, so you just need the dividend for the past 12 months. So you can go to like any website, Yahoo Finance. So they pay a quarterly dividend. So it's in March, and then 20 cents in September. Just go to last 12 months. So December is 23 cents. December is 23 cents. September is 20 cents. Got that. And, oh, I see. March. So I guess they pay 3 dividends a year. This is where it get confusing, but just put in the previous 12 months. So it would be and we could just double check our math later. So shares outstanding is a calculation, 1.3 billion shares. That's just the market cap divided by the stock price. The current yield is 1.2%. Let's double check. Make sure we did that right. 1.29%. So yeah, we did that right. It's not always exact because this is the forward yield, which is actually different than what I'm doing. I'm doing the trailing yield. The forward yield takes the most recent dividend and multiplies it by like 4. I'm doing a trailing yield, which is the previous, like all the dividends paid for the year. So if a company raises their dividend a lot, you may see different numbers. And of course, every day the dividend changes. Buyback, 2.6%. Okay. Okay, so that's how much money, if you own this stock in the past 12 months, you would have received 83 cents from one share. That's how you get the 1.2%, because the yield is the 83 cents over the stock price. And then there's the buyback yield, which was just a plug-in from Simply Wall Street. Then the return. It looks at the current stock price and the stock price last year. So it went down. As you can see, that makes sense. It went from 92 to 72. So it went down 22% in the past year. So if you own this stock, this is good information because not only for this dividend exercise, 2 per year. Well, they paid it in. This website says, no, I think they pay quarterly. I think they pay quarterly dividends. Oh no. What am I looking at the wrong LRCX? Why does Simply Wall Street, this is how you find mistakes sometimes too. So March, they paid. Then in December they paid, so 3 months before March. And they didn't pay. This is wrong. Some people Wall Street, I mean Yahoo Finance is wrong. Oh, 2 payments in March. I see what you're saying. Okay, I think this looks correct. Okay, let's take this. 23 cents in March. December is 23 cents. September is 23 cents. See, it's weird. Like you look at Yahoo Finance and it's different than this website. But this looks correct. 20 cents in June. The reason the dividend goes down then back up is because the first dividend was June 2024. And the second dividend was September 2024. The third dividend was December 2024. And the last dividend was March 2025. But this is just visually to help you. Okay, so 89 cents is how much they paid in the past year. Yeah, I'm going to use this site. I don't know what. I don't know why Yahoo Finance is wrong. That doesn't make things a little harder when websites are wrong. Yeah, for some reason, Yahoo Finance, they do have the March dividend of 23 cents, the December of 23 cents, but they don't have anything else in 2024. They kind of skipped September 2024, June 2024, March 2024. You see what I mean? Like it should be here. It's just like there's not like there's not nobody's typing it in. It's just downloaded the information. So the website they pulled it from, it just didn't match up. So, but whatever. I mean, that's why you do a little due diligence. You don't just rely on machines. And I would hope Simply Wall Street would be correct. If one was correct and one wasn't, I'd hope this website would be correct because I'm paying. Well, I'm not paying, but I got a free version. But you would pay $30 a month for this site. Yahoo Finance is free. But anyways, let's keep plugging ahead. I kind of go off on these tangents. So the yield 1.2%. They say 1.3, but that's fine. It might just be a timing thing. I have 1.2. I always like to use what I calculate. This could be as of like last Friday or something. It was 1.3 because every day it changes, right? This is a nice little feature if you have Simply Wall Street, the dividend yield, the buyback yield. So if you're a dividend investor and you say, okay, I want a stock at least a 3% dividend, you should say at least like combine the buyback and the dividend. And this is 3.9%. And this is just a fun little feature I added. Like this is your return. So you lost 22% if you invested in this stock a year ago, April 28th, 2024. If you bought a share at 92.15, you would have lost 22% on your stock. On the price of the stock went down 22%, but you would have received 3.8% from the yield and the buyback. So you actually lost 18.5%. That's how you should be looking at it. You shouldn't ignore the dividends and things like that. You should always build that in, but most people don't. So if you did invest $10,000, a year ago, you'd have 81.51 today. This is kind of confusing, but this 1.1 billion, this is how much money it cost this company to pay the dividends. So in the past year, they spent $1.1 billion on dividend payments. They gave that to their shareholders. And I liked having that there. So when I calculate the coverage ratios, you understand where they came from. So I think the most important thing is how many times can free cash flow cover that dividend payment? And in this case, it's 3.3 times. So it's and the way you get 3.3, it's a free cash flow 3.8 billion divided by how much it cost them in dividends, 1.1 billion. So 3.8 over 1.1 is 3.3. Yeah, 3.3. And then coverage ratio, the net income, the coverage ratio for net income, you take your net income over how much? So 4.7 billion, that's their net income in the trailing 12 months. And they paid out 1.1 billion of dividends. So they covered 4 times. And this I was just playing around. I added what's the maximum dividend they could pay based on their free cash flow? Because since they could cover the dividend 3.3 times, that means there's room to raise dividend, right? So if they paid out 100% of their free cash flow as dividends, they could actually pay a 4% yield. So they can raise it from 1.2 to 4.1 just on their free cash flow. And that's a pretty simple calculation. It's market cap over free cash flow. I mean, free cash flow market cap. Yeah, free cash flow exactly. Free cash flow divided by the market cap. So, and if they paid out 100% of their net income as a dividend, since they could cover their dividend 4 times, they can raise the dividend yield to 5.1% and still be profitable. And so this is the ranking. So there's only 3 categories, and I'm open to suggestions. But so free cash flow coverage, and I just used an if formula. If this is below 1, if this number is below 1, then the result is 0. So if they couldn't cover their dividend with their free cash flow, if it was like 0.7, then that's a 0. If it's if they can cover if it's between 1 and 2, like if this number is between 1 and 2, then they have a ranking of 1. And if they can cover it more than 2 times, they get 2 points. So that's the first ranking. The second ranking is net income coverage. So if they can cover, if this number, the net income coverage ratio, is above 1, then they get a 1. Else they get a 0. Like if this said 0.6, this would be a 0 right here. And this is consecutive years. So if they've, and that's in this column right here. If they pay 3 consecutive years of dividends, more than 3, they get a 1, a ranking of 1. Else it's a 0. So that's the ranking system. It's just these 3 areas. So the maximum they can get is 4 points. That's the max, and they get all 4. So if you get 4, it's a strong buy. If it's a 3, it's a buy. If it's a 2, wait. Yeah, if it's a 3, it's a buy. Well, let me fix that. Okay. If it's a 2, either way, it's kind of like a 50-50 chance. And if it's anything like a 0-1, it's a sell. So that's it. It's as easy as that, right? So let's do some tickers. So I'll show you it. Oh yeah, Pfizer. And if I do a bunch of tickers, I'll probably be able to change the model a little to revise it, because I was just doing this off the top of my head. So PFE 2305. How much was the stock price last year? Historical data. So 1 year ago, it was 25.58. What's the market cap? 130.7 billion. And what's Pfizer's free cash flow? 9.8 billion. And what's their net income? Pfizer's net income? I had EBITDA in there originally, but then I changed it. Like I had a third section with EBITDA. Even though free cash flow is more important, net income I think is important too. Because net income and free cash flow should be similar over like a really long stretch of time. But in like a shorter time frame, it could vary a lot. Okay, so let's see the buyback. Oh, so they don't buy back stock, it looks like. And you should double check this stuff because this could be wrong. But we'll just assume it's right. 0 buyback. Let's see that how many consecutive years they pay a dividend. So you can see it's pretty much all 10 years. Doesn't look like they missed a beat. So we'll leave it 10, and there's no dividend cuts. Let's type in the dividend. 43 cents. 43 cents January. $42 November. $42 July. And then 42 May. So those are that's all the dividends for the past 12 months. And if they skip dividends, you don't have to take the last 4 dividends, just the past 12 months. So if like they skip these 2 dividends, you wouldn't put anything in. You would just put in here. What's up, team? What's up, Jacob? So $1.69 is, so if you bought a share a year ago for $25.58, you would have received $1.69, which is 7.3%. That's based off of the current stock price, and you would have lost nearly 10%. So if you own this stock, like if you invested $10,000 in this company in April 2024, you'd have 97.44. You would have lost 2.6%, which kind of sucks, right? And they pay out 9.6 billion of dividends to all their investors. So this is kind of either way. I want to do a conditional formatting. If the sell equals either way, oh no, I think I missed it. It didn't work. Let me fix the conditional formatting. Okay, yellow is either way. And if it says sell, I want it to be red. So that's new rule. If it's equal to sell. Okay, so if it's sell, it's red. If it's either way, like the rankings 2, it's yellow, and if it's a buy, it's in green. Strong buy is also in green. Let me change that. Okay, that's fine. What about Zim or ET? Jacob, you're not the Jacob I know, right? There's this guy I know, Jacob. So yeah, so Zim, if we did this with Zim, so we need the stock price, 1447, and the stock price last year. So a year ago, the stock was $13. So Zim went up. Market cap, $1.7 billion. Let's look at that free cash flow. $3.5 billion. net income, and just email me if you want the Excel file. 2.1 billion of net income. Yeah, I had a feeling they wouldn't have any buybacks. So the dividend, I guess it's one consecutive year because they skipped, so it's only one. So let's type in the dividends. So in March it's 317. 365 December. They pay a lot of dividends, that's for sure. August is 93 cents. And 23 cents in June. So 55% dividend. This says 49 because they take I'm not sure how they calculate it. They might do the forward yield or so if you put $10,000 into Zim a year ago, you'd have 16,000 today. 16,600. That's pretty good. That's not a bad return. And that's how much it cost them to pay the dividends to the if they pay $7.98 to all their shareholders for the whole year, it would cost them $1 billion. And they could cover it. They can cover it 3.7 times. So this is the max yield. So they could pay a 200% dividend if they wanted to. And it is a buy. That's the fill. Oh, here it is. And strong buy. Let me have a rule for strong buy. Okay. So if it's a 4, strong buy. Looks a little different than buy. Okay. The key is to find a company's dividend champions who increase their dividend consistently. That's one way to do it. We streamed a month ago. Now that's somebody I know in real life, Jacob. But I was wondering if that was him. But so, what do you guys think of it? It's pretty user friendly. Maybe I should add some more features to it. So, because do you think Zim should be a buy? Well, I mean, they can cover their dividend, which is the most important part, right? They don't get any points for the consecutive year thing. I mean, we could like We could do minus points if they have dividend cuts, we can minus points. LYB. Lyondell Basel. 5872. So last year was 102.55. The market cap is about 19 billion. Free cash flow is $1.5 billion. The net income, that's $1 billion. So let's look at the buyback. So 1.6% buyback. Well, they a really big special dividend, but it looks like they're all 10 consecutive years of dividends. No cuts. So they paid $1.34 in March, $1.34 in December. August, $1.34. And then June, $1.34. So that's the current yield, 9.1%. That matches this website, 9.1%. And then buybacks. So if you did put 10,000 into the company, you'd lose 32% in the past year. This is a sell, or I guess do not buy, because they can't cover their dividend. But their dividend's so high, it's 9%. So even if they cut their dividend to just pay out everything in free cash flow, it would still be 8%. It wouldn't be that bad. If they cut their dividend to be more in line with net income, it'd be 5.6%, which I think is a normal dividend. Which is what in the past they've been paying closer to 5%. Now it's so high. So why is the stock down so much? It's really dropped a lot this year, especially in April. They must have had bad earnings. They pretty much peak at 100. They've done that like 3 times: 2014, 2018, and 2021, and 2022. But then they don't seem to like break through 100 or 120, but they can't consistently stay above 100. Your revenue just is not moving. It goes up and down, but it really kind of stays pretty steady. The average years of increasing dividends is 43 for the stocks I provided. But entering the data in the spreadsheet, it could give you a little more info, like what to look at. Because when you actually when you actually do the work, like if you just looked at a website with just numbers on it, it doesn't sink in. But if you actually do the work, you understand it better, and you kind of start thinking about it differently. At least I do. BITO. Not sure what company that is. Oh, Bitcoin. Oh, they don't pay a dividend. HAFN. Hafnia. Is that the bank? 20. Sheesh. $2.3. What's the stock price last year? $7.64. And 2.2270. And they have free cash flow. $900 million. Net income $870 million. What's their buyback? $2.1. I wasn't expecting to see that. Let's see the consecutive dividends. So this looks like a new company. So I guess they pay it. I guess 2 years. Maybe I'll get rid of dividend cuts because it's hard to do. Okay. March was about 3 cents. December, about 38 cents. September, 40 cents. And May is 34 cents. So the current yield is 25%, which is what's Yahoo Finance? 25%. The buyback is 2%, but the stock went down 40%. So if you put $10,000 into the stock, you'd have $8,700 today. They could cover their dividend. They cover it 1.6 times their free cash flow. So this is either way. It's kind of like a coin flip kind of situation. This I'd probably avoid. This doesn't look like a. Is this like a midstream company? A tanker. Yeah, these tanker companies, it's so risky. They're really volatile. The company's listed on the Oslo Stock Exchange on the ticker HAFNI and New York Stock Exchange. Are we looking up strong dividend companies, or are people just throwing out tickers? Well, either one. I'm just trying to test out the model to see how it works. Mind. Is this MindSpring? Mind Technology. 659. Data. It's up a lot. Market cap. It's a really small company. $52. 52,679. I'll make this millions. Okay. So wait, where am I now? I can't. So market cap. Okay, so let's get the free cash flow. Yeah, it's not going to work with a company that's losing money. Well, it does have positive net income. Yeah, I'll do millions. Um, what's the buyback? No buyback. Does it even pay a dividend? It doesn't pay a dividend? It doesn't even pay a dividend. Um, so I mean, so for the exercise, I mean, you can't really do it. Okay. Yeah, REITs is good. REITs is perfect for REITs. It's ideal for those type of companies because if a company pays like half their earnings in dividends, you do have to take that into account. But you ideally you'd want a company that pay everything in dividends. So it's like it's those are like the best ones. REITs, MLPs, because they pay out almost everything in dividends. Next era. Did I 137? $137 billion. Okay, so free cash flow is $4.4 billion, and net income is damn it, $5.5 billion. You have to be careful how you hype it in. Next era. They went the other direction, so they added shares. They added shares. Let's see the dividend, consecutive dividends. So it looks like they're pretty much all 10 years. $0.57 in February. 50, 52, 51 November, August, and June. So 3.2% dividend. Okay, 3.4. But they add shares, so it went the other direction. The stock went down 1.5% for the year, but if you include the dividend and the dilution, you're actually up 1.7% on this investment. So 10,000 would yield you 10,167 after a year. But they could just cover their dividend. They could only cover it one time. So it's a buy. It's not a strong buy, it's a buy. Free cash flow. But this will be helpful for REIT, the max dividend. So it's still actually they're at their max for free cash flow because they're paying 100% of their free cash flow. They can only cover it one time. Should have listened to Scott on that stock months ago. What stock? Thanks to ET Clue a couple of years ago, up 22%. You're up 22%, but with dividends, you're up like 70% because they pay so much in dividends. Maybe at 70, but like 50. We could see how much you're up in the past year. Just the past year. Yeah, I'm up over 100% on my ET, just on the stock. It's about 60 billion. And a free cash flow. Net income. I'm telling you, Berkshire is still a good buy. they're gonna really take advantage of all that cash they have. It might be priced in though. The cash might be priced into. But I was saying, like the past few years, it's gonna really come in handy. All that money. Because they're an insurance company. They're that's their main business. So as an insurance company, they're always sitting on so much cash. I thought they paid a special dividend. Oh, that's Costco, maybe I'm thinking. Costco's paid a special dividend. I thought they paid something like a bonus dividend. So just in the past year, you're up 8.2% because the stock, I mean, you're up 16%. What am I saying? The stock went up 8% on top of the 7.5% dividends. But that's compounded, you know. So if you made like 12% last year, it's compounded each year. That's why Berkshire holds all these commodity stocks. Because you know, over time they have good returns. But this is either way. The reason, because the net income is below 1, it's 0.97. So they're paying out 100% of their net income, more than 100%. But free cash flow, they can cover their dividend with their free cash flow. So they can raise that dividend 12.2% and still not lose any money. Yeah. I mean, it just keeps going up, but I guess like any stock. But people keep, you know, I've been hearing that for the past 20 years. Oh, he's old. He doesn't know what he's doing. Just, and it's always the same thing. I mean, he happens to be the most important part of the company, but he just runs a company. The company is going to be there forever, not him. So his process. Damn, I wish I would have got it. Look how low it was in the 90s, $50. That's when it came out. It started trading in the 90s. Got what, like 20x. GameStop sitting on 5 billion, laugh out loud. Do companies with more cash, I guess that would make sense that they would but you have to, I guess, look at like not just the cash, look at the debt as well, because if I tell you I have $1 million in cash, you would think, wow, I'm doing pretty well. But then if I said, well, I just took a home equity loan of $700,000 against my house, so a lot of it is debt. That's not nearly as good as if I had $1 million in the clear. I mean, most people, when they take a loan against their house, it's a mortgage. So it's a little different example. But if you took a personal loan for like a few $100,000, if you owe money, then it doesn't really, like if somebody had $1 million with 700K of debt, and somebody had 500K of cash and 500K and no debt, obviously the person with 500K of cash is doing a lot better than a million, even though the person with a million has double the cash. They owe that money. They have to pay it back. But that's just one thing. It gets so nuanced. You got to look at that. You got to look at like a million other things. But NNN is 7-Eleven stores. Yeah, so I think it's a good tool. I know like all these other people. What's that website? What's that that YouTube channel? Those it used to be 3 guys. Now it's 2 guys. There used to be like this guy with this, I think, a reddish beard, like a big guy. He didn't know that much about stocks, but he was like the announcer. But he's not with them anymore. Money, something money, everything money. Is that it? Yeah, everything money. They're doing well, 300,000 subs. If they have this checklist, if they, if free cash flow is up 10%, if they bought back stock and they do this, like, and you kind of like, how many check marks does it have? And I guess those things are good because it gets people engaged and it gives you like a landmark, but those kind of things can be deceiving. But I figured I'll try to put something together. Destination. Yeah. Well, they're doing really well. I mean, they have much better editing and much better presentation than me. And they also have, I think, their own website. Does anybody watch them? Do they give good information? I mean, I've watched a few videos and it was pretty good. I didn't feel like I learned that much, but I think it's maybe more for the everyday trader. Do you guys watch Kill Tony? I've been getting into it. Every Monday, I'm starting to watch it. He comes out with a new podcast on Mondays. I wanted to go. He's coming to Oakland, doing a show in Oakland. I wanted to go, but I can't. I don't know anyone who's last tab. Yeah, they're salesmen. They are. They're good. They are, and it shows. That's why they have so many more subs, and they're making a lot more money than me on their channel. Yeah, they're better presenters. That's for sure. I watch mostly Tasty Live as I'm a short premium trader by work. Yeah, Kill Tony's great. If anybody lives in the Bay Area and wants to go, let me know, because I do want to go, but I don't really know anyone who's interested in that stuff. Oh, my back's killing me. But I think just a simple tool. I could add other bells and whistles, which I might do, but I think it gets a little too confusing. But I think the way it's set up is pretty easy to follow. The buyback thing, I think it makes sense to add that. I'm not sure. I short high implied volatility ranks, so these markets have been fun. Do you need a website, Scott? I was the person you streamed with a few months ago who runs a web development company. Oh, right. You had a really nice website, like really advanced technology, I think. I don't know. I don't think I need it. I don't even know who would I don't think I would get many people to subscribe to it. I think it'd be, I mean, if somebody wanted to do it for free, I guess, but I don't think I would make much money off of it. So I'm not gonna, um, I don't know. I guess it's not a bad idea, but I'll think about it. Um, okay. Well, yeah, thanks for joining. Um, I'm trying to come up with new ideas. So yeah, maybe we'll when I do streams, we can input into this file. It's just another tool to kind of like for your due diligence. You have the DCF, which is the main one, but you can do there's a dividend discount model. So you can email me. I can tell you the Excel for dividend discount model. This is not really a model. I mean, it just says buy, sell, but thank you. Last half, appreciate it. Yeah, very nice of you. Okay, yep, thanks a lot, and I'll talk to you later.